Hello and welcome to a new video from GoodbyeMatrix. I'm in Singapore today on the reserve from Silver Bullion. Joining me as a guest is Gregor Gregersen. Great to have you on today, Gregor.
Yes, hello. I'm looking forward to the interview.
We want to talk today about current conditions, trends and geopolitical events that could cause gold to move positively in the coming months. Gregor, maybe we'll start directly with the first item that's currently on everyone's mind, the topic of the banking crisis. We've seen it in the US, the first banks that are now collapsing and have to be rescued, and it seems to be spilling over into Europe as well. We've seen it with Credit Suisse in Switzerland. What do you think of that, and what do you think the ultimate impact will be?
Yes, well, it seems to be a symptom of a larger problem. First of all, we have long-term debt, of course, accumulated over decades and so on. But now, specifically on these banking problems that we're seeing now, these are largely banks that have been buying government bonds, US government bonds for the most part. In the year 2020, the US has, yes, over 3 quadrillion of government bonds sold, and the banks that bought them at a very low interest rate. The problem is, of course, now that interest rates have gone up then 2022, so from, let's say, 1% or so to 5 or 6% with this bond, the value of these bonds has fallen tremendously. And in the case of a bank, it is the case that more than 90% of the money that is stored or deposited there is used by the bank to make investments and other things. And it seems that the banks thought that nothing could go wrong with government bonds. But a lot can go wrong, because the longer the bond is, the more the interest rate goes up, the less it's worth. And banks that have now gone bankrupt were banks that had liquidity problems. So there were the first problems, and the bank said, we have to find some more money now, and when that got into the news, the investors then said, I'd rather take my money out of the bank because something could go wrong. And that then led to this bank run with too many people wanting the money. Banks usually only have 10% or less available at short notice, and then the bank just had to start selling these government bonds and other assets that they have. And since the value has dropped so far, they couldn't hide it anymore. And so they went bankrupt overnight. That happened very quickly. So first Silvergate Bank, then Silicon Valley Bank, then Signature Bank. Then later it spread to Credit Suisse. So it all happened very, very quickly. And I think the problem is not only with these 3-4 banks, because the problem has every institution as well as individuals who bought bonds which are long-term and with very low interest rates.
I think it's a general problem of the whole system. All banks are affected regardless of the system or the country.
And through the corona times, yes, the US has sold a tremendous amount of those bonds. That is, probably a lot of institutions bought these bonds, which have now fallen very, very much in value. It's not just government bonds, it's also other bonds, because interest rates are so low. And the banks, as well as other people, have become accustomed to receiving very low, in Europe, even negative interest rates for 10 or 15 years. So they didn't even think about what would happen if interest rates went up. And that's what we found out now, what happens when interest rates go up. And then these bankruptcies happened. And what one should perhaps say about this. The decision will then always come back. Yes, what do we do now? If you have an account with such a bank, then you are insured up to $250,000 or so by the state. And then most people think, yeah, that's why it doesn't have that big of an impact. But the problem is Signature Bank, for example, was one of the main banks for Kraken, the crypto exchange. And they just had several $billion that are stored there. And if that money goes down, what happens to the investors who have a balance with Kraken? And that's just this counterparty risk that exists in the banking system.
So this guarantee system doesn't actually have enough liquidity to be able to pay everyone out in the end. If more banks go bust all at once, or no longer have the liquidity, then this protection fund could not actually pay out all the people in the end, and larger people not at all anyway.
That's always not such a problem because it's somehow about the father state, which then comes back in anyway. And as he has now shown again, not only the insured, but everyone was paid out, because simply the understanding is there that the whole financial system is so fragile that you can't allow medium-sized banks to go bankrupt. Because if this continues, other investors will take their money out. Then it will become clear who has bought these bonds and who will have problems as a result. That is, this can be like a beginning of a chain reaction, which then spreads and spreads.
So you can imagine that it won't just stay in the US, but can also spill over into other countries in Europe, or even spread internationally in general.
It has. Credit Suisse is a Swiss bank. And it's not just banks that have this problem, pension funds do too. Pension funds.
That's what insurance companies have. They invest in government bonds for the long term. That's what the government wants.
Exactly. And now interest rates have gone up so fast, and that's why there are many skeletons lying in the cellar.
Or dead people.
That people would rather not know about. And that's why it's always about reassuring people.
So really, it's just about maintaining confidence in the current system and in the banks, right? And if the confidence is gone, then it will just collapse eventually if everyone would try to pull the money from the banks.
Exactly. And banks normally don't have to report the majority of their investments at market value. So they don't have to disclose the real value of the investment at that point in time. They just show the nominal value. And that makes the bank look okay on paper.
So on the outside, everything is nicely calculated on the balance sheet, and so because...
Yes, because that's not a realized. So they didn't sell that. So they don't have to show it as a loss on the balance sheet. But if they have to sell it because people just pay out their money,
then this loss will be realized, and exactly, then it will also be reflected in the balance sheets, and the banks will go bankrupt directly, very likely. So the sums are so big now that it would no longer be tradable for the banks.
And the problem is, if Father State comes in and keeps giving these bank bailouts, then the currency itself will weaken over time.
Through inflation, which is caused by the money supply evaluation.
Yes, and one of the problems that's important to understand with inflation is the amount of money that goods are looking for, so I can print as much as I want. But as long as the money is sits somewhere and has no velocity of circulation, then it has little effect on inflation. But as soon as people start buying the goods and there aren't enough goods, then of course inflation goes up. But in the same way, if there are fewer goods now and the amount of money stays the same, then inflation also goes up. Because it always depends on how many goods there are and how much money is trying to buy those goods now. And now, in the last 20 or 30 years, we had a period where China produced goods very cheaply. The goods were then sold cheaply in supermarkets and so on. And so we had a period of 20 years where this was practically a paradise. So from an economic perspective, inflation didn't go up because China produced things so cheaply. Interest rates can be low. Everybody has money because it was very cheap. Everybody can have a lot of money. That means everybody. The money was just very, very easy to get. And now the opposite is happening because China is not so cheap now. And because of all the geopolitical problems, there will be less and less goods coming from China now. For example, a lot of the iPhones are produced in China. Now the US is saying, China, you can't now order the machines that you can use to produce chips. But now you need those machines to make an iPhone. That means, where will this iPhone be produced next year? Because if China doesn't get those machines anymore, then there will simply be more and more bottlenecks. The last 20 or 30 years, there has been a lot of globalization, which has become more and more efficient. Now it's changing. And that means there will be fewer goods. The goods will become more expensive, and that will make inflation
rise. So even if the money supply were to go down again now, or even if the velocity of circulation were to go down a bit, the fact that there is less supply on the product side will still keep inflation up. That is, these efforts to raise interest rates by the Fed and so on and so forth by the central banks is then actually has little impact.
It has an impact because inflation would be even higher if they didn't do it. But there are fundamental reasons why inflation will continue to rise. Because we have printed a lot of money in the last 20, 30 years. The efficiency of production of goods is getting less. That is, the quantity of goods is getting less. And as people become more worried, they may become less invested in stocks and so forth. And this whole combination makes it a very difficult period.
I think also Corona has also again strongly to do with it. So that's now the whole previous period. Then came Corona. Everyone was somehow locked in at home, or many people were. And many were somehow from the PC, have perhaps traded a bit of stocks of crypto. And many people got the money for free from the state as rescue money. And at some point, yes, then the economy opened again. The borders were opened. People were able to travel again and could suddenly spend the money again. As a result, the velocity of circulation surged upwards from one day to the next. And that also ensured that strong inflation was driven, right? Because everything has been piled up over the last 2 years via Corona.
Yes, to a certain extent, but I think over the next 10 years, we're going to be dealing with the consequences of these trade wars, of these embargoes, of the decline in trade.
So you think that has a long-term effect? So we can't hope now that 2024 everything will be peace, joy, and cake again. That means you should really focus now on how do I get my assets to safety and how can I protect it?
I mean, we have seen it now, a war between Ukraine and Russia suddenly costs food much more. Ukraine as a breadbasket falls away, and in addition, high oil prices. That in turn brings up electricity prices. All this is interconnected. If we now imagine a war, or an economic war between the US and China, the effects would be even greater. And then at some point, the other point comes, because a currency, the only value of a currency today, is the confidence that people have in the currency. Because it's not backed by anything, it is backed only by people's confidence in the currency.
I believe that it has value and that I'll get something for it tomorrow, and I trust that. And the state?
The state says that this is the official currency. Trust. But if people do not trust it, then we will have a repeat of the Weimar Republic. The Reichsmark, which lost billions of times its value, that is just the death of a currency.
Do you think we've already reached the point where the loss of trust is so severe that we'll see hyperinflation again in the next few years? Or do you think it's not there yet?
It actually always takes longer than you think. But the problem I see is that there can be a so-called catalyst. There can be one or two events that trigger virtually all of this. For example, there's a very interesting book called Currency Wars by Jim Richards. Jim Richards did economic games at the Pentagon, which is for the American military. where he played China, there were simulations made of asynchronous wars, so wars where we don't fight each other with weapons, but we try to destroy each other in other ways. And economics is one of these methods. And if countries now try to destroy their own currencies, then you have to look for an alternative. And gold is always one of those alternatives because gold is not political.
Gold is neutral, like the Switzerland of money.
It has an intrinsic value, that is, a value of its own, which now does not depend on who created the gold. And it could be that at some point China says that they're not going to accept US dollars now.
Currently, this trend is already developing more and more. I wanted to talk to you about that in a moment. The topic is also very exciting.
And if something like that were to happen, then that would lead to a potential crisis in the US dollar.
So we currently have, if we summarize it again briefly, as the first point of this explosive cocktail, I say, for precious metals, is that we have a banking crisis. And that means that you, as an investor, should now think about whether you don't take the money out of the bank, because you have seen the first banks are going bust. So why still keep money in the bank? Then we have inflation. We've already addressed that. Your money is indirectly destroyed by it. That means we have less and less value. We get less and less for our money. And then we have on the other side international trade wars, which are also developing now currently. Also that the US dollar is losing more and more importance, or potentially that this can develop further. And before we talk about that, I want to talk to you very briefly about that, about central banks. Because what I've noticed is that when you watch now in school or on TV or something, everybody always tells you, but you shouldn't buy gold because it doesn't pay you any interest or silver. And that's all a relic from ancient times. But on the other hand, central banks are currently buying precious metals and gold like crazy. So mainly gold. Singapore has also stocked up heavily again in 2023, and they're clearly going on a trend. And why are we being told that we shouldn't do that, so as small investors, but they themselves are buying gold without end?
From my understanding, US dollar is the largest reserve currency held by central banks. Euro is the second. Gold has now become the third. Central banks are buying gold for the same reasons we talked about before. One reason people are told don't buy gold is that there are very small margins in gold. If I sell insurance now, I don't know how it is in Germany, but here in Singapore they pay a good 30% commission. So you make good money on it, you earn very well on it. So if I am now a bank or a financial advisor or something, I can earn well by selling a pension or insurance. But if I sell gold now, then the customer goes and looks at the international price of gold and says, why can't I get that price? Because gold is more like a currency. It's very transparent. It's almost like a currency. And if you now take a 1% margin of gold, then that is already relatively much. And if you are someone who is trying to earn money, would I rather sell you insurance or would I rather sell you gold?
And the nice thing is that you are then also bound to the contract and have to pay in for the long term, and you may not be able to get out so easily due to laws. That means you earn money in the long term as an insurance broker.
And you have this whole counterparty risk. Because if you now have such an insurance, the insurance has to try to make an earnings somehow. And the safest way to make money is to buy government bonds. We have just seen what happened with these government bonds, with the banks that bought a lot of government bonds. So you have a lot of risk, you pay a lot in commissions, which you don't see yet. And it's just very profitable for companies that sell it.
It's interesting because you say it has a lot of risk, but normally you are always told that there is no risk at all, or that it is the least risky thing to have government bonds, to have insurance, and so on and so forth. But if you look at it closely, in depth, it has a lot of risk. All these entanglements.
Exactly, and the other thing, which is just important, if you think only in euros, And you say, yes, before I had 100 euros, now I have 102 euros. That's why I'm richer. If you have this way of thinking, that is the nominal way of thinking, then it is always safer to buy a government bond. Because the government will always pay. That's not the problem. The problem is that if inflation goes up by 10% now, and my roll now costs €1.10 instead of €1, then I can't buy my roll with my €1.02. I can no longer buy my roll. That means I have a loss of a little less than 8%. That is a 7-8% loss. And it's important that people don't think in nominal terms, but also think about what I can afford with this money. Because the euro, the US dollar, and so on are currencies that always lose value every year. On average, the US dollar has lost about 3-4% in value.
That's already heavy.
That's the average. So if you don't make at least an average of 3-4%, you lose. Gold? If you calculate that in US dollars, on average, the value has gone up 7-8% a year.
So we don't even need an interest rate from that point of view on gold.
So now if one holds gold long term, it doesn't pay dividends, it doesn't pay interest, but it doesn't have to because it just always goes up in value long term, while currencies always go down in value. And you have to try to get enough more currency to keep your purchasing power going. And once you understand it, this concept is actually easy to understand. But I would guess that a good 60-70% of people don't understand this concept.
Sometimes it is also difficult. It's just very tricky. This system, I would say, you grow up with it with the understanding that you are rich if you have a lot of money in your account or something, and everyone only trades in euros or US dollars, so you don't see any gold in your daily life. And inflation is so creeping and so indirect, it's only really noticeable after 50 years when I retire that you suddenly lose the money you've saved. The money you've saved up isn't worth that anymore. Sure, now you see it faster because inflation is so high, but in the past, when I think about my parents...
The problem is most of the time you see that when you go to the supermarket and you see high prices, a lot of people then say, yeah, that's the supermarket's fault.
The entrepreneur is to blame again, he wants more profit.
But the truth is, if you keep creating money out of nothing, the money becomes worth less. And you see that in the form of higher prices. And the balance is, as long as that loss of value is not too high, it's more or less okay in the long run. But when inflation goes up quickly, as it is now in the US with almost 10%, then people become more aware of it. Now it's just visible. Yes, and when this mentality starts, where people say, yes, these goods are getting more and more expensive, I'd rather take my money and buy them now because they'll be more expensive tomorrow. Then there will be more and more money that tries to buy the goods, which will increase the price. Rises. The seller who sees, yes, I'm getting more and more people who want to buy this now, and the money is getting worth less. Now, I'd rather make my prices more expensive today than tomorrow.
It's like such a negative downward spiral that keeps accelerating.
Exactly. And that's what 1922, or from 1918 to 1922, happened to the German mark, the Weimar Reichsmark. That's it. It's all about psychology. The bottom line is that it's relatively simple. When people start losing confidence in the currency, that's it. And as a central bank, as banks and so on, it's just very important that the confidence stays in the currency.
And that's why they tell you, okay, don't have gold because you can trust our currency at that moment, that's for sure.
Because as a state, all your power, a large part of your power is in the currency. If the currency is no longer worth anything, how do you pay the police? How do you pay the army? How do you pay airport personnel? Everything stops working. That's why it's the be-all and end-all. The problem is, if you put more and more pressure on the long term, then the risk that something will go wrong at some point just gets higher and higher. You don't know when that can happen because it's mainly a psychological thing. But when it gets to that point, it can happen quickly.
And I think that's also what you're seeing right now with this trend that the central banks are buying more and more because they understand that. I mean, they're not stupid. They are preparing for such a potential collapse, and they also want to be independent of these international trade wars, which we will now address. But for you as a viewer, it's important to understand what you just said. People are starting to hoard. Maybe in Germany they start hoarding toilet paper, which doesn't make any sense, but at some point someone gets the idea not only to hoard toilet paper, but then tries to buy precious metals, gold and silver. And when you get to the point and you haven't prepared, you don't have any physical precious metals in your portfolio yet, but everybody wants it, or a lot of people want it all at once, then it becomes very, very difficult. And the price then, of course, also skyrockets extremely. So it makes sense to be prepared.
The important thing is to understand that there is a difference between physical gold and silver and paper gold and silver. Because paper gold and silver is practically just a loan, where there is usually no gold or silver behind it at all. If we go into a financial crisis now, it's most likely not worth anything because the bank or the institution would possibly go bankrupt. That is, that gold loan has no value. In addition, the gold was usually never there in the first place. And in a crisis, the premium, the extra price of the physical metal goes up rapidly.
Because everybody's trying to get the gold coins.
Exactly. In 2008, for example, when I became interested in the whole thing, the price of silver went down further and further to $15 an ounce. But the physical metal, you'd have to pay $30, $40 for that because nobody was selling.
The official price had decoupled from the physical price. You can see that now again a little bit, so not so much anymore, but during the COVID crash.
Yes, so the premiums of coins, for example, have gone up. But the worse the crisis, the bigger that difference is going to be. And if you are such a trader now, as long as I can call a refinery now and say I want to buy 50 kilos of gold at the spot price, the traded price that's shown on TV, as long as I can buy that, that's the right price. But in a crisis, if I'm then told, yes, but nothing more will be sold because we have too much demand, we don't get physical gold. And then they don't give a price, or they say the price is now 40% higher. Then the TV price is no longer the real price. That is the price that is still traded in the financial brands with paper gold, but not the real price. This is the price that is still traded in the financial brands with paper gold. And those are just the reasons why it makes sense to buy some physical gold and silver. Not so much as an investment, but more as an insurance policy, a real insurance policy, but one that also increases in value over the long term. And I don't see much downside for anyone in taking 10-15% of their assets and buying physical gold and silver with it, and then storing that in a way that hopefully it won't be at risk if a major crisis happens. Some people might put it under the bed, some people bury it somewhere, other people take it to a company like us. And it's also worth storing it in a different country than where you live. Because that's diversification, so that you just have that 10-15% as hedging money somewhere else, which is supposed to be safe if something happens at home. And that is the principle on which we have built Silver Bullion now.
So to summarize that now a little bit, on the one hand, we now have the banking crisis, where you no longer know whether your money is still safe in the bank. Then on the other hand, we have the trend that central banks are starting to acquire and accumulate a lot of gold themselves. And now, as a third point I wanted to make in closing with you is the issue of international trade wars. You see that the US dollar is going to lose more and more of its importance, apparently. So that's a trend that more and more countries are saying, we don't want to trade only in US dollar anymore, but we also accept now euro or yuan or whatever currency. And how will that ultimately, if that really comes to a head and the US dollar as a reserve currency, that doesn't happen overnight, that can happen maybe in the next 10 years. That's a trend that has also existed for a long time. But how will that affect precious metals then? Precious metal prices ultimately, if the US dollar is no longer the flagship of the world?
So I think you should see gold and silver as a currency in itself, which is not specifically a country now, but a
And if there is
basic
a crisis in
currency.
the US dollar now,
And I could imagine now, for example, that if this an economic war expands, USA will not allow American or even European. Chip manufacturing machines to be exported to China. But that is a very important thing for China. Maybe at some point, times China says that I'm fed up now, the Americans are giving me more trouble than it's worth, and now I'm hitting back. And if I were China now, I might also say I'm no longer accepting dollars to sell my goods. And China now has about 30% or so of world trade, and now that would mean that all the countries that want to trade with China would all of a sudden be with euros, with gold, with yuan, or with any other peso or whatever is accepted, but not US dollars. That would mean that all of these countries would now have to sell US dollars all of a sudden in order to get another currency with which they can get Chinese goods. And that could be a blow to the US dollar, from which the US dollar might not recover. I would imagine that the US would see that as a financial attack, and that they would then in effect make embargoes against Chinese companies.
and there is the question, how can this be enforced with the BRICS countries now that they are already so strongly networked among themselves? They have built up everything so strongly in recent years.
To give you an example, HSBC Bank. HSBC is, after all, Hong Kong Shanghai Banking Corporation. Carrie Lam, that was the CEO, after all. Of Hong Kong, it was the equivalent of the president, the chancellor, so to speak, of Hong Kong. The US has... HSBC said Carrie Lam is now on a list of people who are not wanted. You can't have bank accounts. That would be just like the US now telling Deutsche Bank, the German chancellor is now not allowed to have an account. And HSBC had to follow American regulations. If you're Hong Kong now, you don't really like that. So if now the German chancellor can't have a bank account because the US says, I don't like you now, chancellor,
then you are no longer master in your own country.
Exactly. And that's just the type of thing that's happened in the last 10, 15 years, where a lot of countries are saying, I don't want to go totally dollar-based anymore. And in Hong Kong now, it's like they've made laws that it's illegal for bankers to follow such restrictions. So if the US says Carrie Lam can't have a bank account, it's illegal to do that. And if you are a banker in Hong Kong now, then of course you have a big problem. The only reason it hasn't gone wrong so far is because those laws are not being enforced. But those laws are there. And if there comes a point now where the Chinese or Hong Kong says they're going to be enforced now, the laws, then there will be a split in the financial system. Because banks will then probably have to decide, do I trade now with the USA and allies, or do I deal with China and BRICS countries? And they have fallen out with each other in such a way that I can only trade with one because they both have laws that don't allow me to trade with the other. And if that happens, then I could imagine that one bank would become the Chinese bank, one would become the American commercial bank. And then they have to trade with each other somehow, or the banks now have a department here, a department there. So it would become a huge crisis and dispersion of the system. And if that happens, then a lot of things will change very quickly, and the value of the US dollar could fall very quickly. Now, if you value gold in US dollars, which is how we value gold, then the amount of US dollars needed to buy an ounce of gold would just go up dramatically. That is, the price would go up many times over. So if we now look at how it was in the Weimar Republic, I mean, there was an ounce of gold that was suddenly worth 20 billion marks or dollars. Or dollars, price mark, or as you see it. Yeah, so the worse the crisis gets, the more important it is to have physical gold and silver.
The big problem, which I also see here, is that I'm just a normal investor. I'm not in these circles of heads of state and central banks, CEOs or whatever. And I don't know what the final outcome will be, whether the US dollar will continue to be the world's reserve currency, or whether it will be the yuan, or a completely different currency, perhaps a newly created currency that the BRICS countries will bring onto the market, or whatever. But with gold or physical gold and physical silver, yes, I have the ability to just put a layer on top of that to protect myself from that, because no matter what currency ends up trading or in which one wins, at the end of the day, my gold always has an equivalent value, so in any currency in the world, and that's actually what you just have to understand. You can hedge with that in this area.
Exactly, you just get out of all these problems very easily. Because with gold, you can own it directly, which means you have no counterparty risk. And it's its own currency. It's not based on the dollar, on the euro, and so on. And because of those two factors, you've already covered the biggest risks that there are going to be now in the future that we're heading towards.
So to put it in a nutshell, you become your own bank. You could say you manage your assets yourself then, if I really am the owner of physical precious metals and store it at home. And then there is also the option, as you said, to diversify and have it stored worldwide, for example, in Singapore. Finally, Gregor, I always get the question from the community, why silver bullion and why actually Singapore? I mean, now many think there is still Switzerland or Liechtenstein. I can also store precious metals there. Singapore is so far away, maybe potentially it has problems with China or something. So even now, when you think about these trade wars, do you think that would have more of a positive impact on Singapore than if the Chinese yuan was used more as a global trading currency? You have a lot of Chinese people in Singapore, which is also very culturally anchored here. Tell me, why actually Singapore as a jurisdiction and why silver bullion for storing precious metals?
So with a trade war, usually everybody's going to lose, but the important thing in a situation like that is to stay neutral. And I think the countries that manage to stay neutral are going to be some of the best off.
So like in World War II with Switzerland, for example?
Exactly. I mean, the Second World War brought so much destruction. Switzerland benefited. Switzerland benefited from it in the end, and something similar is coming again now, I would say. So it's important to stay neutral. And then you have to ask yourself, of course, how strong is the country from a financial point of view? Because the fear is that if we have a crisis of the US dollar and the US dollar loses value, then a state like the US has to create a new crisis, a new currency that people can trust. And usually gold plays a big role in that, because people can agree that gold has value. And if this new currency is transparently covered with gold and also other valuable things, then that could be a currency that reestablishes trust with. The problem is, where is the US going to get all that gold? And if you look at history now, in 1933, the US nationalized gold. At that time, the US dollar was still backed by gold. However, the US was in the Great Depression, needed money, wanted to spend money, which they didn't have. But if they just print the money, then people could just take their dollars to the government and say, give me the gold, because I saw you're printing too much there, you better give me the gold. And that is the function of gold.
A reserve asset as well.
But if there is a clear cover, then it limits the ability of the state to just print money. So a state has to stay
So
honest,
that
so
it
to
is
speak, with
covered
its money.
1-to-1 and not print more than is actually there.
Or maybe 1.5 covered, because yes, they print a little bit, 50% more, but people don't notice it that way.
But that would be already no longer honest.
And the US has the problem. How do I print the money now? But my currency still has to be gold-backed. So they said, I'll just make it illegal for Americans to own gold. And everybody who owns gold now had to turn that gold into a government agency within 2 weeks. Got $25 for it. And if that didn't happen, then you could get $10,000 fine. That was a lot of money back then. Or up to 10 years in prison.
So gold has become like cocaine. Yes, nobody wants to own it at that moment.
After that, they then said, now each ounce of gold is worth $33, and practically created 30% more dollars, with which they then built Hoover Dam and so on. And since then, they have printed more and more and more until in 1971, they printed so much that the countries like France said, say, you're printing way too much money. Give me back the gold, I'll give you back the dollars that they've printed so much of. And then the US state basically said, yeah, shit. Change, now we're not backed by gold. And now gold is just trading freely. Americans are allowed to buy gold again. And since then they have just... The US deficit has practically gone from 300 billion or so, that is trillions, has grown by at least 30 times. And that's without taking into account the pension systems where there's no money in it, the whole healthcare systems, the medical care where there's no money in it. So, since the US dollar is no longer backed by gold, it's just printing. And that brings us now to the current situation where the risk for the US is that people will lose confidence in the US dollar, and they now have to nationalize gold to recreate the new currency. Yes, and that's one reason why we now have many of our customers who are with Americans. They just don't want to store their gold in the US.
But how can you help? Because if the US says, now you have to hand over your gold, if you keep it illegal, we'll put you in jail, then you just send it here from Singapore. Or just get it.
That's why people are now sending the gold to Singapore and similar countries. And then the question is, as you just said, what is the jurisdiction of the USA? How far does the arm of the USA go? If we now look at HSBC with Hong Kong, then it can quickly become clear that the US has almost full control over every Western bank and also over global banks. Has almost full control and also on globally operating companies. If USA says, I'm canceling your bank accounts, then a company can't go on much either. That is, the power of the USA is actually global in the Western world at least, and therefore the question is, what happens with the gold that is now stored in Singapore if there is a request from the USA to send the gold back to the USA? And that is the question where you are in Switzerland or wherever, that every country and every company has to ask itself. And we have built this company from the very beginning with the basic idea that this will happen one day. And that's why we said, we don't want to be global. We do not want store gold in the USA, in Europe, or anywhere else. We want to store it only in Singapore so that we can only have to listen to Singaporean law. And you guys are also only in Singapore.
And you're only registered in Singapore as a company.
And now if I get a notice from US authorities that all of a sudden gold has to be sent to USA, then I just say that I don't recognize American jurisdiction in Singapore, but that I'll take it to Singaporean court, and then they can deal with the Singaporean court. First of all, that will take years. And secondly, then the question is, does it make sense for Singapore to nationalize gold like that? Would that make sense, or would it rather not? And I would say it doesn't make sense. For two reasons. The first reason is that Singapore itself is a rich country, so Singapore doesn't have to. Not have to nationalize gold. There's no reason for it because they don't have the... Exactly, there is no reason. The second, more important point is all of this wealth in Singapore comes from the confidence that Singapore has built up over the last 40 years that there are no prohibitions, that Singapore can be trusted. That's why all these companies have moved to Singapore, wealth management and so on and so forth. If Singapore does something now that destroys that trust, it's economic suicide.
Because there's nothing else here, so you don't have any raw materials or other things to build on.
Exactly, and to the Singaporean state, it's very, very clear. First, that the state has to be well defended, including militarily. Second, that it must remain neutral. Fourth, that trust is always maintained. These are three principles in Singapore that are very, very important. Are very, very important. And these are also the principles that have made Switzerland strong. And if you now look internationally for places where you can store gold, in the past we had London, we had New York, we had Switzerland, we had Hong Kong, we have Singapore, London, and New York are kind of falling away a little bit. Hong Kong is off the table now anyway. That means that all that's really left is Singapore and Switzerland. Liechtenstein, yes. And I would assume that if you live in Germany now, the argument for putting some gold into Switzerland is not wrong. But it might be worthwhile to put something in Switzerland and also something in Singapore. Because if something is far away, that has advantages and disadvantages. The disadvantage is that it's far away. The advantage is that it's far away. Right, yeah, who knows what can happen in Europe? Who knows what will happen to Switzerland? I think a lot of Germans have already realized that banking secrecy is long gone, or wasn't what it was before. And if you want to secure money in the long term, not money, but value for your children and so on, then it makes sense. Children and so on, then it makes sense to add Singapore as a diversification.
So you just build up your different baskets in different jurisdictions and thereby protect yourself through diversification. And if one pillar breaks, for whatever reason, if it's Switzerland in that case, or if my gold is stolen at home, then I still have my money or my gold in Singapore at that moment. And I haven't put all my eggs in one basket.
And Switzerland, of course, is in Europe, and that means that the problems or the mentality is just always shaped by Europe. And if this mentality goes in a direction where it would suddenly become illegal to hold gold, then Singapore is the other side of the world. It's very unlikely because it's so far away. These are all factors why it makes sense to hold something in a country like Singapore.
What significance does gold have in Chinese culture?
Chinese in Red China or in Singapore?
In Singapore and also traditionally in China?
Well, in Singapore it's like this. Traditionally, of course, gold has a traditional value in almost all countries. But in Singapore, people have very great faith in the state. And when people have great confidence in the state, then actually the need for gold is not so great.
And do you see that here as
we
well?
We have customers in Singapore who are looking internationally to see what happens. But If you look at ordinary citizens, they don't see the need for gold. They don't see the need for gold because they feel safe here. If you go to India now, every Indian knows exactly what gold is and probably has some gold because the trust in the state is not there. If you go to Vietnam, it's still the case today that if you buy a house now, that part of the house is probably paid for under the table with some gold. Because they've gone through several wars. So whether you have the currency of the winner or the loser, the currency is probably worth very little. And you just learn to have some gold because no matter what happens, the gold will always have value. And you can emigrate with the gold somewhere else and the gold will have a value and you can start a new life again with it. That's why. Now the demand for physical gold in Singapore is not so high locally. But the interesting thing about Singapore is for the international investors who bring their gold to Singapore because they are looking for that security. They are also looking for the security of having a state that they can trust.
What's also interesting here, if you ever come to Singapore, go to Little India, and there you can visit all the gold dealers. There are sometimes all the stores full, and everyone just wants to trade and somehow buy the gold. You can really see how this is culturally anchored among the Indians. With the Indians, I think it was a great conclusion to understand that it generally makes sense to include precious metals in the portfolio. At the moment, we have the problem with the banking crisis. We don't know anymore if the money in the bank account is safe at all and which banks will go bankrupt next. Deutsche Bank could be the next to perhaps also get problems, or other banks, about which one does not think. Then we have that. The states more and more start to acquire gold itself, and they're also apparently indirectly prepare, plus the international entanglements, that there somehow trade wars can take place, and the US dollar maybe also more and more importance will lose. So actually all points where one can prepare oneself with gold and silver relatively well, one simply from this whole system gets out and look at it from afterwards, simply from the parallel, one could say.
And you have very little to lose. There's almost no downside to that.
I can always liquidate it again if I need money. That's always a thing. Very, very liquid.
It's an insurance that costs little or costs nothing, increases in value over time. And it's a real insurance because you're practically no longer a participant in the financial system. And it is not based on a national currency.
Gregor, thank you very much for the interview. It was very exciting, and if you would like to visit Silver Bullion and also store precious metals in Singapore, you can find below the video the link to Silver Bullion. On that note, Gregor, thank you very much for this.